Hey, Saretsky here. Welcome back to the show. Want to put a quick video together here to discuss, obviously, the Bank of Canada rate cuts, what that means for the housing market, and Build Canada Homes, the $13 billion announcement from the Carney government. I'm going to walk you through the implications of that and ultimately what it means for the broader picture. Bank of Canada, as expected, 25 basis point rate cut. Again, market odds are over 80% coming into that meeting for that 25 basis point cut. So really no surprise there. What it means immediately for mortgage shoppers is that your variable rate mortgage will come down 25 basis points. So most variable rate mortgages today are prime minus, call it 0.7. So I would take your variable rate mortgage to basically 4%. Which is pretty much in line with where your fixed rates are. Again, if you're a good borrower and you have a few relationships at the bank, happy to, of course, make connections to the context that we work with is, most fixed rates today are around 399, 409, sort of at that 4% mark as well. So basically, the variable rate mortgage today is effectively in line with the 3 and the 5. There's really hardly any difference between those three terms. So effectively what I'm saying is there's no real increase in borrowing power today for new buyers. I mean, they've already have these rates had they gone fixed rate, which about 75 to 80% of the market goes fixed rate. Again, that fixed rate, it gets priced off the bond market. And we know we've seen some movement in the bond market over the last month, down about 25, 30 basis points. So you should see your fixed rates drop even further, maybe another 5, 10 basis points from here, but effectively not really any net new purchasing power. Now, again, if the Bank of Canada continues with these rate cuts, obviously that can be a different conversation, maybe sometime in say the spring of 2026, right? Even you've got BMO out and, markets pricing in another few cuts from the BOC that would bring your variable rate mortgage to, let's say, the low threes. If you get another 50 basis points today, and your prime comes down, your discount off prime goes down another 10, 15 basis points, you'd be looking at variable rate mortgages in the low threes, low to mid threes by, let's say, next spring. That's a big difference. So that's a big difference that I think would then kickstart home buyer demand. But today, that's not the case. Now, keep in mind, this is a huge boon to, I think we've avoided the worst of that mortgage renewal cliff. Remember, 60% of all Canadian mortgages over the next 18 months are renewing. Some are renewing at lower rates because they took 2 or 3 year fixed rates a couple of years ago, but a lot of them are coming off these fixed payment variables or these 5-year fixed rates. Now, again, I think we've avoided the worst case scenario. Why do I say that? Keep in mind that about 18 to 24 months ago, mortgage rates were in the sixes. Whether you were on variable or on fixed, you were like 6.2, 6.3, 6.4 in some cases at the height of the high interest rate environment. And so what I'm saying is you got it from 6 down to 4, and your variable is probably moving lower over the next, call it 6 months. So we've avoided the worst case scenario. That's not to say there isn't going to be defaults and more stress in the system. I think it's likely that delinquencies still move higher. But I think we've avoided sort of that worst case scenario. Think about the pain if you were actually most people renewing today in the sixes. I mean, it would be a much different story than, again, in the high threes. So, again, fade a lot of the news articles, headlines that are coming out. You had RBC out this week saying, oh, we're worried about house price appreciation. Guys, there's no appreciation when you have months of inventory at 8. There's 8 months of inventory here in Greater Vancouver. I think the GTA is roughly around the same. New listings in Canada, second highest August on record. Guys, there's a lot of inventory to clear. So yes, lower rates certainly help demand and overall affordability, but there is a lot of inventory to clear before we can start even contemplating rising prices. The reality is given current inventory levels, you're going to probably see further downwards pressure on prices through the back half of this year. And again, I'm not going to start forecasting where we are in the spring of 26. There's a lot of variables that can go into play. So through the back half of this year, the writing is on the wall. There's simply too much inventory. We've talked about it again here in Vancouver. 8 months of inventory on the market. Record number of shadow inventory. That is unsold condo units on developer balance sheets that doesn't show up in those official resale data points. And so again, I think what we're going to see is people that need to sell, want to sell, have to sell are going to have to reduce in a market that is bloated with inventory despite a 25 basis point rate cut and probably another one coming in October, given the air cover they received from the US, the Federal Reserve, of course, cutting on the same day by 25 basis points, with more cuts expected in the back half of this year. So that's kind of the outlook for the mortgage picture, the housing picture. Again, fade a lot of the headlines that are suggesting, imminent buyer demand and higher home prices. That is not in the cards for the back half of this year. I want to also talk on Build Canada homes. I think there's a lot of important distinctions to take away here. So the Carney government announced Build Canada homes. Effectively, what it was $13 billion of taxpayer dollars that is designed to basically create a new agency. Think about CMHC. It was a new agency called Build Canada Homes. And effectively, what it is they're going to take federal land and they're going to develop it. They're going to go and hire a private sector builder developer that actually has experience building homes. But they're going to ask them to basically, and they're using a lot of these funds towards starting up facilities for manufactured homes, prefab homes, effectively. So like effectively, it's like homes built in warehouses, and there's a lot of nuances here, but effectively, what they're going to be doing is they're going to be building social housing. So the initial plan is, okay, we're going to launch the first capital seed funding of this is $13 billion. And we've announced we're going to build 4,000 modular homes. Now, if you break that out, that's $3.25 million per home. They say, well, guess what? We can scale this up. We're going to have all these modular home factories that can scale up this building. And even if they scale it up to the 45,000 homes that they're promising, again, government targets never, ever get hit. 45,000 homes, that would still be about $289,000 a door. But ironically, the scale up actually involves more funds. The initial is just to develop the framework. So effectively, it's $13 billion to develop the framework, which will push out 4,000 modular homes. Guys, I mean, I think it's going to be ultimately my view here is, again, this is social housing. This is not housing to purchase. This is not for young people to get on the housing ladder and start building equity. This is you're going to rent from the government. Government is going to spend $13 billion creating an agency to then funnel it to private sector developers, government. People that are close to the government are ultimately going to be enriched here. And they will build these homes and they will do tremendously well. And you will rent from the government. So I am not a proponent of this. I think that there's a need, obviously, for low-income social housing because the private sector can't necessarily develop it because it's unprofitable. So I can see the government trying to fill that void. But if we were talking about, is this going to create sort of this more prosperous Canada where people are, getting on the housing ladder, building equity, and we're helping out the young people that are priced out of home ownership? No, this is going to make no difference whatsoever. And $13 billion throwing at modular homes, I think is crazy. And it's kind of like that old adage is like, you'll owe nothing and be happy. I feel like this is like the precursor to that. And again, ultimately what it is, I think it's going to be like any government program. They say like one of the best ways to get rich is basically to start a company and get the government as one of your largest contracts. And so like government just has unlimited money to spend. They're not price conscious. They're just prone to getting ripped off. And so if you can become a government insider on the private sector, you will probably make a lot of money. And I think this is ultimately what's going to happen with this program. It's rather ironic that, the founder of Mattamy Homes, which is one of the largest home builders in the Ontario region, announced back in June, I don't know, maybe it was back in April or May. But anyways, earlier this year announced that he's getting back into the modular home business after a failed attempt many, many years ago. He's getting back into it. And it's rather ironic the timing that he's getting back into it because he knows the government funding is coming his way. So again, I think if you're a political insider, this is a fantastic program. But I think for the rest of Canada, when you're looking at the maximization of your tax dollars being spent, I suspect that $13 billion will be spent, and the results of which will be very, very pathetic. And that's like, again, all these government contracts and grants. We've heard of all the scandals over the years, and I suspect this will probably, unfortunately, be another scandal where the government should have focused is the program that has been the most successful. We've seen the results is the CMHC financing program. Now, again, people might say, "Oh, I don't like that," giving developers these jumbo 50-year amortization loans. But guys, if your goal is to add more housing, the results are in the data. The data is showing you that rental housing under construction is at all-time record highs. All-time record highs in places like BC and Ontario. You have like roughly 16-17% of all rental housing stock under construction today, because of this program, which is basically it's worked. It's worked. So why not just keep running with that program? The Carney government also proposed the MURB, the MURB program, which is the multi-unit residential building program. And effectively what it is like, it's tax incentives. It's tax incentives to the private sector, allowing them to effectively write off more of their costs up front, against their, personal income taxes, for example. And so the tax incentives, along with the favorable financing, I think would have stirred a ton of rental housing construction. As we've already seen, just adding that MURB on top would be a whole lot better than creating a $13 billion government agency with more bureaucrats trying to figure out how to build housing and ultimately getting ripped off by the private sector. So that is my view. Again, happy to debate and discuss in the comments below, but that's what we've got this week. Got the BOC rate cuts, no real changes to home prices. I still think we have downwards pressure moving forward on home prices. There is simply too much inventory, and the government program that is ultimately going to funnel tax dollars to political insiders. And I mean, I guess on the flip side, on the bright side, I suppose it'll take a lot of the construction workers who are soon to be unemployed, given where housing starts are going. I suppose they'll be taken off those sites over to some of the government housing that will be getting built. I suppose that's a silver lining. But let's wait, let's watch, let's see. As always, we'll be here dissecting, and we'll see you next week.